Semiconductors are the talk of the town at the moment due to the global chip shortage creating problems with manufacturers as consumer demand for advanced technologies continues to grow. But the industry has grown from massive hype. With market sentiment cooling off since the Fed announced increased rates, it's wise to be cautious. I've gone over the data and I've narrowed it down to one chip company that I think offers the most genuine value and stable growth for investors. Here we go. This chip shortage is starting to have some real impact on companies. I outlined in my previous coverage on the electric vehicle industry that some manufacturers have been forced to compromise on their designs, using analog devices because they couldn't source the necessary chips for planned technology. With Tesla, despite Elon Musk claiming they had plans to source chips internally, their latest report outlined that this hadn't gone to plan and they were short of chips and had to drop new models to 2022, including the controversial Cybertruck. The stock plummeted on the news. Meanwhile, technology companies continue to push the MetaVerse as justification for why the stock is rallying. MetaVerse will require billions in investment to achieve, without knowing how exactly it will work as a business model, and the legality of the industry is yet to be worked out, so I'm being cautious. Consider the bullwhip effect. This is a phenomenon of the distribution channel when demand forecasts yield supply chain insufficiencies. Or put another way, is when there is a sudden consumer demand for a product, so manufacturers further up the supply chain respond by increasing production, but as each manufacturer in the chain adds a margin of safety, the supply becomes increasingly more than the long-term demand requires. And when supply exceeds consumer demand, the system crashes. What we're seeing in the semiconductor industry is a market built on the potential of market demands. And as demand currently exceeds production, and the current order to delivery time is anywhere from 18 weeks to 6 months, manufacturers are ramping up production, expanding or building new facilities with new equipment, more staff, flooding logistic networks, and sourcing new materials. To cover the costs of this expansion, the EU commissioned the European Chips Act with an initial €15 billion of a €43 billion investment by 2030, with the US trumping this last June by pushing through the Innovation and Competition Act, which includes $52 billion of investment into domestic chip manufacturing. But this amount is less than half of the $114 billion Japan will be spending to double their domestic production by 2030, and pales in comparison to South Korea, who announced their Semi-Conductor belt aimed at building the world's largest semiconductor supply chain by 2030, with $450 billion in funding over 10 years. The industry is without a doubt responding to demand in massive ways, and there is a risk that it catches up. The market could be flooded with supply, overwhelming demand, and the market could turn brutal. Massive competition affecting profits and investors pulling back. This makes it risky to invest in companies where growth has already been priced into the stock price. So instead of getting swept up in the hype from market demand and promises from CEOs, it's important to focus on the fundamentals of what these companies can realistically deliver in terms of market growth and financials.
21, 7 times 1, 7, 7, 7 and 1, 8, and 2 to carry, 28.
Out of the choices available, I think Qualcomm continues to offer genuine value for investors and has fundamentals strong enough to withstand a correction. Here's the background. Qualcomm, established in 1985, focuses on wireless technology. Originally they were operating at a loss until 1998, when they restructured to focus on their highest margin patents, including 2G mobile technology and semiconductors, of which they outsourced the manufacturing to the infamously known Taiwan Semiconductor. The following year, that's 1999, they became the fastest growing stock on the market with a 2,621% increase. Their CDMA technology represents 39% of their sales, became the standard for 2G services in North America, which was the catalyst of their market dominance. They also secured revenue through 22% of their business in licensing agreements and 22% in wireless technologies, and they established themselves worldwide with offices in Europe, Asia Pacific and Latin America. This continued to grow, and by 2007, Qualcomm's technology was utilised by mobile networks in over 105 countries, including licensing agreements with Nokia in Europe, Nortel in Canada, and Mitsubishi in Japan. Their continued focus on patented technology led them to develop 4G, and by 2012 they had 81 patents protecting their technology, and by 2018 they secured partnerships with over 19 mobile manufacturers and 18 carriers to bring 5G to market. Qualcomm's influence is so significant that their technology can be found in every 3, 4 and 5G smartphone. Lower economic countries who are still developing their 3G and 4G services, such as the continent of Africa, and companies such as Balti Airtel, are using Qualcomm licenses for their expanding broadband services. I covered this subject in my previous video, link below. These advances come under Qualcomm's technology division, QCT, but it's also their patent licensing division, QTL, that give them a clear advantage in a competitive market, particularly the mobile market. Consider this: around 16 years ago, the retail market was yet to determine the future of home media to replace DVD. There was a choice of HD DVD manufactured by Toshiba or Blu-ray, invented mainly by Sony.
Fight!
A defining moment came when it came to the next generation of games console. In 2005, Microsoft released their $400 Xbox 360 console, and followed this in 2006 with a $199 HD DVD player as an add-on for their console, which would eventually come bundled with King Kong. Sony released their PS3 console in 2006 for $499, but unlike Microsoft, they included a Blu-ray player built into the console. Despite the slightly higher price, Sony were praised for the inclusion of Blu-ray in their consoles, and the company was able to flood the market with Blu-ray players through their 87.4 million console sales. Microsoft sold only 316,000 of their HD DVD players, and the distribution ended in 2008.
Fatality!
Blu-ray dominated the market, and Sony, along with other contributors, have been able to license out their Blu-ray technology ever since, including to Microsoft. So when it comes to technological innovation, patents on marketing dominating technologies are worth a fortune and can have a profound effect on how the market develops. For 2021, Qualcomm reported over $2 billion revenue from license fees, a 13% increase from 2020. Which is unsurprising given how they hold over 140,000 granted and pending patents. That's right, when you buy Qualcomm you benefit from such hits as local area network client participation in a network slice, default communication configuration for communication across carriers, and who can forget channel equalization for wireless communication devices, and many more. You can benefit from thousands of great patents by ordering Qualcomm stock today. Price correct at posting. Consult your broker for details on praise and spread. Qualcomm's long list of patents gives them increasing relevance as they are relied upon by evolving technologies from different manufacturers. Page 14 of their 2021 report shows an abundance of legal cases based on patent usage by competitors. For example, in 2017, Qualcomm were able to sue Apple over billions of pounds worth of mobile technology that infringe upon 3 of their patents, such as one which allowed manipulation of screen size and another which allowed icons to be manipulated. Apple challenged this, but they were rebuffed by the courts last November. The companies have settled with a 6-year license agreement for their technology to run until 2025, and is likely to be extended for a further 2 years. And this year, Qualcomm are expecting to close a $4.5 billion deal to acquire Veoneer, a Swedish provider of automotive technology, through their driver assistance technologies, which Qualcomm plans to incorporate into their Snapdragon automotive platform and deliver an advanced driver assistance system to major automotive manufacturers including General Motors, BMW, and more recently Renault Group. So Qualcomm are keeping in line with the current market demands, and they have opened an engineering software office in Berlin to support their European partners. As for the MetaVerse, Qualcomm have announced a collaboration with Microsoft to build their ecosystem, including lightweight and efficient augmented reality glasses, and plans to implement Microsoft Mesh and Qualcomm Snapdragon Spaces XR developer platform. Microsoft's Xbox brand includes extensive acquisitions, such as with Minecraft creators Mojang, Fallout creator Bethesda, and most recently Call of Duty developers Activision. And this means they have already expanded their digital development arsenal. Microsoft's experience in business services such as Microsoft Teams, virtual meetings and document sharing, along with their expansion into the gaming industry, means they are in a unique and prime position to lead the metaverse in both business and social markets. CEO Satya Nadella has explained how their gaming franchises such as Minecraft and Halo are metaverses in their own right, and Microsoft aims to utilize these communities to bring people together in the digital world. Combined with Qualcomm's unique patented technology and technical production facilities, I think the partnership offers a sensible entry into the metaverse and could place Microsoft far ahead of Facebook in terms of practical development. Now that's my pitch, but as always, here come the financials. Now, in their 2021 report, Qualcomm reported handset technologies has grown by 42%, largely due to a drive towards 5G infrastructure. Then the Internet of Things comes second with a 31% increase thanks to Qualcomm's lead in Wi-Fi solutions. Licensing has brought in almost $2 billion in revenue. And overall, we are looking at a 35% annual growth in their revenue across their technology division and 10% from their licensing division. Qualcomm's revenue has been growing well over the last few years, with 2021 showing decent quarterly growth, and Qualcomm are standing their ground against their competitors. From their rate of growth, they are second to AMD and Nvidia. Their profit margin shows consistent growth, which is supported by income and EBITDA. Cash has been steady for years, but they have been growing their asset worth and gradually decreasing their debt, particularly over 2021, which provides a steady increase in shareholder equity without having to dilute their stock. Their earnings per share is also showing substantial growth, and their dividend history has been consistent. On January 8th, the company announced a dividend of 68 cents per share, which will be paid out on March the 24th to those who own the stock by March the 3rd. Last October, the company announced a $10 billion stock repurchase program, additionally to the remaining $0.9 billion from a previous program. And this trend is apparent from the general decline in common stock levels. So the financials are positive and consistent, providing a reasonable indication of continued growth. But there are threats to the business. COVID remains a threat to all businesses such as Qualcomm, but I think this subject is done to death and not unique to Qualcomm, so I'm going to focus on more specific areas. An increasing portion of Qualcomm's revenue is reliant upon a small number of customers and key licenses. So if those customers face disruptions or switch to competitors, it can have a significant impact on business volume. A significant portion of Qualcomm's business comes from China, so increasing tensions between the US and Chinese governments poses considerable risks. This has urged companies to re-evaluate their reliance on Taiwan Semi-Conductor, who manufacture 54% of the world's semiconductors and over 90% of advanced processors. Qualcomm have started moving some production to Samsung, who will be manufacturing their latest 5G Snapdragon 8 processor. However, technology giants Apple, Tesla, Amazon and Google are looking to in-house production, which could decrease their reliance on incumbent suppliers, which include Qualcomm. However, moving production in-house can pose risks to production quality, once you factor in issues of supply chain, manufacturing skills and increased production costs. It is often more cost-effective to outsource production of specialist advanced components to specialist manufacturers than risk the manufacturing and installing of defective products, which could increase costs and delays and damage reputations. The semiconductor market is somewhat volatile due to advancements in technology and fluctuations in supply and demand. Qualcomm's patented technology is becoming increasingly relied upon by the industry, and why their licensing revenues continue to climb. This unique selling point gives them a more predictable and consistent growth pattern. AMD and Nvidia have had a more successful year, but largely due to the chip shortage and MetaVerse hype, and they currently trade at a premium as a result. Nvidia's 10% drop over the last month seems to be justified with their failed acquisition of ARM, and AMD's similar fall wasn't helped by Zuckerberg linking them with his Meta plans, just before their stock took a dive over claims they are losing relevance. Qualcomm haven't made the mistake of overpromising, and the Microsoft deal is a more grounded and realistic entry into the metaverse. They are far more reasonably priced, trading at around 19 times earnings and a price to sales of 5.15. Price to book of 17.81 with a future PE of around 17, with a general consensus from analysts that it should be around 20% undervalued. Qualcomm also boasts a 1.5% dividend, which takes the edge off. I already hold Qualcomm as one of my largest positions, but I bought in early, so I already have a strong position. I think it would be wise to avoid buying on highs from earnings or more metaverse hype, but at current levels I think they still offer a good long-term investment, with any future dips presenting opportunities to buy in at a genuine discount. So that's all I'm covering for now, but if you have any thoughts or questions, please comment below, let me know, and consider subscribing so you don't miss out on any future videos, particularly that I continue to cover my entire portfolio. If you found this coverage particularly interesting, I suggest seeing my video on Airtel Africa and the electric vehicle market. Links below. Until next time.